All right, guys, we are live and I got the recorder going. Julie, I'm glad you were able to reschedule. And thank you for the question. So the question was, what is implied volatility? How do we use it, and so forth? And I believe the exact question was, it says, what does it mean when a stock has a 105% implied volatility? You're looking at QURE. So the first thing you want to look at, QURE, we know that it has options because there's implied volatility. Does it have the requisite open interest? It does. There's, the in and around the at the money. You have, a few thousand. That's good. It's not great that we have 70-cent wide and $1.20 wide puts. Bid ask. I would be concerned about your liquidity, not so much from the open interest part, but from just how wide that market is. So let's just say, and I'm just arbitrarily saying, let's say we want to buy a put spread here, $5 wide put spread. The market on that thing is 90 cents at $3. What trades in between 90 and $3? I have no idea. 195 is fair market value, which is just 90 plus 3 divided by 2. But sorry, I was just answering a quick thing over here. So I would say that unless you had kind of intimate knowledge of the company, nothing where I'm talking about insider stuff, but if this was something that you were in and used to, that would be fine. I would probably steer away from this, given the fact of, well, when we have $5 wide strikes, plenty of open interest, but wide markets. But for the purposes of the question, we can certainly still use this as an example. So you were asking what a 105 implied volatility means. Implied volatility of 105, that means on an annual basis that you can expect through one standard deviation, which is basically 67 or 68% up, 68% down, you're going to have it is going to be worth 105% more or 105% less, which in that case would be, let me pull in a spreadsheet here. Just getting a little blank spreadsheet here. So if we have something that's trading basically $64, if I can type, well, that means that basically within one standard deviation, 68% of the time, we are going to be, it's going to equal that times 32%, and it's going to be that times, so it's going to, so basically this thing, is going to be, they're saying, I don't know where it's going, but it's not saying here, but that's on an annualized basis. And as you can see here, and we have earnings coming up. Earnings, they're estimating it at on the 14th of August. That you can see that the implied volatility, okay, for August it's 102, because that May. This is saying that, this is the estimated. This vol up here is saying, yeah, this earnings report is probably going to come out before August 16th. So you see that August 16th vol is 101.8. SEP is lower than that at 98.3, 92.7, 89. So that's what you'll see. You'll see that when you get up to earnings, you'll see that time structure start to go in what we call backwardation, meaning that shorter term implied volatility is higher than longer term. So what does that mean? Well, that means that people are more willing to pay for gamma. And so we know that gamma is strongest in a shorter dated option as compared to a longer dated option. So they'll pay more for that. So the simple laws of supply and demand means that price must go up. A normal thing, so let's look at something like Twitter. Twitter came out with vols. This is one-day volatility. It's very hard to look at this, but you can see where vols were before earnings. Let's knock this one out. This one was trading about 95, 94, excuse me. This one was trading about 71. This one was trading about 61. So you can see that, but now you can see how that's flattened out. That's the mean reversion that we talk about when we are talking about things like earnings, or if there was a big report coming out from the government, unemployment, F1C. You'll see that shorter term stuff get juiced because of that gamma. But what does that mean? So 105%, and I actually what was it? QUAR? I've never heard of the company. That's what I'm looking at. Sorry, I'm going back. QURE. That was close. I got the Q part right. QURE. Okay, so what this is saying, now we're not talking about this on an annualized basis, and this is where we bring in that spreadsheet that I put together for you guys, where we can calculate that standard deviation. Given an implied volatility that we're looking at, what can I expect between now and then? So, first we need three pieces of information. 63.73 is where we're trading right now. This is going to be regular August expiration, because that's going to encompass the August 16th here, because earnings are coming out before that, and that implied volatility, I have 101.5. That's what I was using. So given this slice of time and this volatility, and this is where the underlying is, we can figure out what is a reasonable range. And so when we do a vertical spread or a broken wing butterfly or a calendar spread, we use the implied volatility to give us what is a reasonable place. Okay, we've decided through whatever means that we want to get long or get short, or we think that it's going to stay here and we're going to do some sort of iron condor. What's a reasonable spread to put on? Well, the market is telling us that this is in the neighborhood of for this slice of time, we're looking at about a 22.5 to 23% move between now and the 16th, which most of that vol is in there because of earnings. And so the full standard deviation is over here on the left. And then I made this dynamic if you want to look at a different confidence interval. If you think about a standard deviation in terms of confidence intervals, that would be a 68% confidence interval, and I tend to use somewhere around a 59% confidence interval, simply between a 50 and a full standard deviation. Depending on how aggressive I think that the move could be, I might shade a little bit more towards the standard deviation if I think it's going to be a little bit less, or me looking through this, the risk reward, maybe I think it's going to be more of a grind, maybe I'll go more towards the 59% confidence interval. So if you were trying to play something, and I don't know if you have an idea of what you want to do going into earnings, QURE, just pulling in a chart here. Okay, so I'm not exactly sure what you're looking at. It is, the channel is moving down, given today's, it's down about almost 5% today. It was in a general upward slope. It's gone sideways and now it's come down. I don't know anything about the company, so I don't know what happened. It kind of blasted right through the 50-day moving average. It's through the 100-day moving average. It bounced at these lows here. It's a little congestion area. Now it's finding resistance here at the 100. So I would say, in the short term, this looks to be a little bit bearish. We're also getting a swing down. This is the hourly chart. This is looking bearish, but that's like I said, if it were me, I wouldn't be playing this at all from an option standpoint, just because of the liquidity that I'd be worried about. In a split second chart, $6. All right, well, let me see if there's any news that came out. Industry conferences. I don't know what that. I don't see anything. Uniquire to participate in multiple upcoming industry conferences. Why that takes the stock down, or if that's why, I didn't see any news. But it seems to be a bit of a lackluster. So, but if you were looking to the downside, excuse me, let me get that. You would be looking to target something in the neighborhood we're trading at about $50. That's a 59% confidence interval, and the full standard deviation is a little more aggressive, targeting the 48. We only have $5 wide strikes, so you'd probably have to do something along the lines of a 50-55 put spread if you're looking to the downside, because you don't want to target 45, because then you're doing much more than a. We can see how big of a confidence interval that is. Is that like a 75? It's even more, 80. So you're looking at it like an 80% confidence interval to get down to 45. Can't do that. So that's how you use implied volatility. Implied volatility measures the magnitude of the expected move for a given term of time. It doesn't say anything about direction. High implied volatility does not mean that the stock is bearish. Low volatility doesn't mean that it's bullish. Now, implied volatility does tend with a pretty high success rate that when stocks go down, implied volatility in general goes up, and when stocks go up, implied volatility goes down, just like the stock market. The stock market tends to go up slowly and then come down fast. How do you determine the distance? The distance between them is based. First, you have to identify what strike you're targeting. And in this case, I said we should target 50, and I'm just using the case that we're looking for a bearish spread. And then you work your way back, and you say, well, how much reward to risk do I need? Well, we really don't have too many choices in what we can do. We have the 50-55 and the 55-60. The 65s are already in the money. I wouldn't do that, because then you're paying for intrinsic value, and why would you do that? So then that's when you bring up the calculators, the spread calculator, and this guy's trading is going to be a big bid-ask spread, so we can see how wide this spread is. It's a credit bid, so of course it's not going to trade for a credit. You don't get to buy a debit spread and receive money. It's offered at 190. So this thing is probably trading somewhere in the neighborhood. I would say it's probably trading somewhere in the neighborhood of a buck to a $1.25. So if we do a buck to a $1.25, this is the 50-55 put spread. If we buy this and sell this, we know that it's going to max itself out at 50 or lower. We have to pay, let's say we have to pay $1.25. You're getting 3-to-1 there. If you get it for a buck, you're getting it 4-to-1, right? Because 4-to-1. So those are pretty high reward to risk. Of course, you need a pretty big move, but that move is priced in. So now, just because something has a high implied volatility doesn't mean it's necessarily expensive. Let's look at where implied volatility is here. Okay, this is on the high end of where, let's get 2 years. I don't even know if it's been around for 2 years. Okay, so we can see that over the last year, this is on the higher end of the spectrum. But we also saw that vol got as high as 222. Well, suddenly this doesn't seem so expensive. Now, I don't know what was going on with this thing or what the liquidity of these options were back then, but there was a lot of implied volatility going into this earnings report. Now you're on the higher end of the last, what is this? What day is this? This is November. So, last 7 months or so, 8 months, it's on the higher end of things. So just because it has a high implied volatility in absolute terms does not mean it's expensive, because you can look at something like even like a Facebook. Facebook trades at like a 25 vol. Well, suddenly a 38 vol, when compared to what it kind of normally is in this range down in 25, well, that's quite expensive. And we just saw with QURE. Well, this isn't necessarily expensive. You can get a lot more expensive. So you have to kind of compare apples and apples there. But then, once you define your target, then you work backwards to give yourself whatever risk reward your risk tolerances afford you. For Scott and I, it tends to be anywhere between 2.33 and 3-to-1. If it gets below 2.33 to 1, it's really not worth, I don't think that's enough reward for the risk. And if it gets above 3, I would rather pull my strikes closer to the money, give up some reward for a higher probability of profitability. Okay? Any questions on that? I hope there are. There should be. Well, you're very welcome. You asked the question. It's not a particularly long video. It's only about 15 minutes. And if there are any more questions, let me know. We can talk about it more. But let me get this video put together for you, and there's a bonus lesson for those in the option vol room. I'll put this in the option vol room as well. But quite frankly, I think most people that are in this room also have access to Scott's. It's not necessarily true the other way around, because let's face it, Scott's a lot more popular than I am. He's the CEO of the company, right? And I will say that his room has been around for a lot longer than this one. But that's why I appreciate you guys so much. Pardon me. And I get to spend time over in the option vol room too. Do I have a tutorial on the various tabs on your spreadsheet? Yes, I do. Let me find it. It's called like the Trading Tool Explained or something like that. Let me find that and I'll put that out there. But let me get this up and running. I'll put it in the room. I'll also put it on the blog today if you guys want to look at that. All right. Thanks a lot.